Welcome to the HMO Property Show. By investors, for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I'm your host, as always, Neil Gibb. And today I want to talk to you about a few different things. Three different things, to be fair. Number one is going to be the RBA cash rate and the effect I think it's going to have on the market. Number two is going to be some of the latest REWA stats have been released, and I don't quite agree with them. And I'll tell you more about that in a second. And lastly, but not least, I'm going to tell you about a new leasing model that we found for the HMO, which helps you as the investor get a head lease on that property that guarantees your rental income for 5, 10, maybe 15 years time. And that rent is pegged to CPI as well. So for all the risk-averse people that always say to me, can you guarantee the rent on these? I can't, because I can't control the market. However, now we do have somebody that will take a head lease on these and pay that rent every single week, so that you get your income guaranteed as an investor. So first and foremost, the RBA cash rate. I think everybody's been waiting for this thing to come down, right? And whilst it will push the market along and potentially bring more people into the market, I don't think people are going to be coming into the market because it's gone down based on the numerical factor. The markets are driven by is two very strong emotions. And them two emotions are fear and greed. Now, when the cash rate's been going up, a lot of people sat on the fence and they sat there and they waited to see where this thing was going to plateau out. And it went from, I can't remember the exact number, 0.2% or something ridiculous like that. And then it sat around the 4.35% for a very, very long time. Felt like an eternity, right? As an investor, you're just chomping at the bit to get in there and keep buying, refinance, want to buy more properties. The market's going crazy. But it just sat there at 4.35% for what felt like an eternity. Now, because there was uncertainty in the market, people still sat in the fear emotion. What if it goes up? What if it continues to go up? I mean, I can hardly afford everything it is. When it was dirt cheap, my interest rate was like 2%, 3% from the bank. And now it's gone up to like 6.5%. And I'm on beans on toast every week because I invested in a 4-bedroom, 2-bathroom property on the outskirts of Perth or the outskirts of Melbourne, and it's not cash flow positive. Yeah. Well, let's not go down. That's another rabbit hole I could go down and start talking about 4 things. But to stick in with what I was talking about, the people that knew, the people that have been through these cycles before, the people that know that everything moves in cycles, knew that at some stage the interest rate would come back down. And these people made the smart moves first. And I've been saying on this podcast for probably the last 30 episodes, guys, if you wait until the cash rate comes down, you're going to get caught in the stampede, because that is when the emotion swings from fear to greed. And then people have certainty, and then they move back into the market. And that's what we're seeing right now. There's transactions going on, a lot of transactions going on in the market now. Not ridiculous amounts. When we look at the stats on REWA, they are, I've just got them in front of me. You know, we had 940 sales this week. 4 weeks ago, we had 832. This week, last year, we had 972. So, you know, spiked it a little bit. Also, it's the right time of the year for the market to move as well, because we come out the back of January. The kids have gone back to school. Everybody's kind of went, right, time to knuckle down now. I'm going back to work. It's time to get my investor moving. And again, you should have been buying in December and January. Now we've got February and the rate's gone down, and that's going to bring more people into the market. So just be wary of that, guys, when you are buying property, putting bids in on property, negotiating on property, because it will affect how much you pay for that property. Second, before we get on to the second, where do we think the rate's going to go anyway? You know, we've shaved off 25 basis points. I've been getting emails from the banks and all the mortgages we've got saying we're going to drop your interest rate. However, I heard somebody else saying the other day that, and it was a mortgage broker saying that you need to contact the bank to make sure that your monthly repayment reduces in line with that rate, because what they might do is just leave your monthly payment the same so that you're chipping away at your mortgage faster. Not a bad thing if you're paying down debt. However, if you were focused on cash flow, then you might want to reduce it to the minimum payment so that you can use that cash flow for something else. So I think we're probably going to end up in December sitting around the 3.1 to 3.2% cash rate. Heard it here first, guys. Once it's out there on the internet, you can never take it down, right? So I hope I'm right. I've been wrong before. The good thing about opinions is everybody's got one. So 3.1 to 3.2% by December 2025. Next thing that I want to touch on, and this pissed me off a little bit because it's kind of spreading false news into the media. Last week, REWA released their latest market stats, and they've been pushing this out in newsletters and on social media and blah, 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 blah. They're saying that the vacancy rate in Perth is 1.9%, and once it gets to 2.5%, we're at a balanced market. And I'm thinking to myself, how have we got nearly a 2% vacancy rate when this time last year we were sitting between 0.4 and 0.7%? And more importantly, when you look at the Perth Market Insight market snapshot that REWA release, so if you type in REWA Perth Market Insights, it will take you to something that they release every week. And I read this religiously every single week to see where the market's sitting. I see how many transactions are going on, how many properties are renting, more importantly, what's on the market. Now, I've been tracking these stats, and we have been hovering between 1,700 and 2,100, 2,200 for the last 18 to 24 months, right? And this is when the vacancy rate was at 0.4 to 0.7%, the worst it's ever been in Perth. This week, we have properties available for rent as released by REWA, 2,024 properties. So how have we gone from a 0.4 to 0.7% vacancy rate when we've been hovering between 1,700 and 2,100, and now the vacancy rate's doubled to 1.9%. However, we've still got 2,000 properties available for rent on the market. It doesn't make sense what they've released. Now, put this out into the world of social media. Obviously, it's always good to get other people's opinions. And somebody said that the vacancy rate is calculated by dividing the total available for rent at any given time by the total number of rentals in the market, which makes sense, right? So if you've got 10,000 properties available for rent and you've only got 1,000 available, then you're sitting at a 10% vacancy rate. Yes, right? So what he then followed up by saying, if the total number of rentals available for rent has stayed around the same, but the vacancy rate has gone up materially, then the only answer is that the total number of rental properties in the market has dropped. So if we've still got 1,000 properties in the market, and instead of having 10,000, we've got 5,000 properties, that vacancy rate increases to 25%, I believe. 22.3, something like that, 23.25. You can see what I'm saying? So it's kind of like false news that they're being put out to make it sound like the market's recovering when it blatantly isn't. So sorry, REWA, you've got that wrong. And I think the headlines you're being putting out there are not right, and you should correct them. There you go. Coming from myself here, sat in my little office, calling the shots when you guys are the governing body for real estate in Western Australia. Well, let's be honest. If we're going to push that them sort of numbers out, they need to make sure that they're actually aligned. We've still got a massive housing shortage. We've still got population increase in the state and planning on 80 to 90,000 people moving to the state this year. And we're only going to build around 16,000 houses again this year. So therefore, the delta that we're in is going to increase. It's going to get bigger. So this problem is going to get worse before it gets better. And I still think Perth is in a really, really strong location for more and more capital growth into 2025, 2026, and potentially 2027 as well. Because until supply outstrips demand, then people were going to pay more to live in houses. People are going to offer more to live in houses because there's not enough housing supply to meet the people, the demand that need the houses. So it's just a fundamental, basic fundamental of supply and demand that will just keep this market going where it is. Now, there's obviously macro and micro data that we can look at as well in certain things, and certain suburbs, don't get me wrong, will definitely slow down, stop, or potentially go backwards. I'm looking at you, Mandurah. I'm looking at you, Armadale. I'm looking at you, Rockingham and Gosnells. Why? Because they were driven by investors, and a lot of them bought at the bottom, pushed the market up. Then fear, when we go back to fear and greed, fear brought in a lot of other people that pushed that market up to the point where people from Perth were looking at it going, well, it's costing me 700 to 750 grand for a 4x2 in Armadale, or for 900 grand, I can live in Success, Hammond Park, Spearwood, Hammy Hill. Where would you rather live? It just doesn't make sense. And I know some people might not have the borrowing capacity to get from Armadale to there, but if you're going to buy it 700 grand in Armadale, then why wouldn't you do what you can do to get into these better suburbs? Now, I believe they've still got pretty good rental yields, but let's be honest, if you put too many investment properties in one area, then there's going to be an oversupply of rentals. That means people that need to rent properties will have choices to choose from, and therefore properties will sit on the market longer, and then people will start dropping their prices. This happens all the time, right? This is why we're very conscious as a company where we put our HMOs and why we don't put too many in one suburb. Because as a property management business, it would look stupid if we're saying, we know there's demand here, Mr. and Mrs. Client. If you build this property, we'll rent it out for you, and these are the room rates that we'll get. But the thing is, with the standard investment property, they've just chased yield, and yield is only available in so many areas based on the price point that you pay for the property, divided by the rental income that it gets, or multiplied by the income that it gets. And a lot of investors jumped in because it's a low price point, it's affordable, and it was giving them a good yield. They've rode that wave up, and now what's going to start happening is a lot of these East Coast investors are going to pull out their cash, which is potentially doubled, and they're going to take it back on the East Coast and they're going to invest it over there. What does that mean for Perth? It means that the people of Perth, the owner-occupiers, the first-time buyers, and some investors will then start to pick up bargains in them fringe suburbs that have seen a lot of investor activity. However, with the interest rates starting to decrease, it now means that people in that middle band, and if we talk about the low, the middle, and the high, which I released on a podcast a few weeks back, I would say the low bracket was the 350 to 7. I'd have probably said 350 to 650 at the time, but because now Armadale's worth 750 grand, then I'm going to say 350 to 750 is that bottom tier. And you've got all them low price point affordable, I'm going to put that in brackets, affordable suburbs in that low bracket. And then when you look at the next bracket up, this is where all the owner occupiers, the people of Perth, and other investors that aren't just chasing like a quick capital growth run by buying at the bottom and selling at the top. People are looking at long-term investments and long-term growth and steady growth, stable growth. So when you're looking at these other suburbs, you're looking at Success, Hammond Park, Careen, I've gone blank, Duncraig, Hammersley, Balga, all these places that priced higher than all of them kind of low area, low socio, low demographic sort of affordable areas, right? And then let's say $750 to $2 million. And then $2 million plus, that's where the cream is. A lot of people are buying in that space, are using cash anyway. They're not relying on mortgages, so they're not too bothered about interest rates coming down. There will be some movement in that, but not as much as what there will be in this middle bracket, because now, when the interest rate drops back down, people in these lower tiered, or let's call it the lower bracket suburbs, can all of a sudden now afford to tip into these middle suburbs. And this is called the ripple effect, where they move out from the suburbs that they've been in into the next best suburb for them based on what they can afford and what they can borrow from the bank. So I believe this middle tier is going to be the one that's going to move the most in 2025. That will naturally pull up the bottom tier again, but it will not move as fast. In my eyes, it will not move it nowhere near as fast as what it has done previously. And I think that mid-tier is going to see like the 8 to 12% capital growth. So there you go. There's my little bit on the RBA cash rate and my little bit on the vacancy rate. Now, more importantly, what I wanted to talk to you about today is, like we said earlier, for the people that we've spoken to in the past, or for the people that like certainty, when they are investing, and something like a rental guarantee is something that they really appreciate and are attracted to, then what we've got now is companies approaching us, the HMO Property Co, and our management teams in living rooms and reside, and they've seen the 6-bedroom, 6-bathroom properties that we have been bringing to the market, and they absolutely love them. They love them because they can now house multiple people in one house. They can get accommodation for either their workers or the people that they need to care for, and they're in areas that they want to live, or people want to live. So let's think about quickly the 3 reasons that the HMO is so successful. And number 1, affordability. These rooms are priced at an affordable rate for people so that when they get priced out of the normal rental market because they can't afford a 3x2 or a 4x2, they then get access to these affordable housing options in terms of rooms for rent within a HMO as being a micro apartment. Number 2, it's convenient. These houses are located in areas that they want to live. Now, we don't know that they want to live there, but we know how to find areas that people want to live in. And then when we put them houses there and advertise them, then people come to us to rent them rooms, knowing that they have either work in that area, family in that area, relatives in that area, or have got some tie to want to be in this area, right? Generally, work or family is the 2 biggest things that we see. And then the third thing is community. HMOs build community in a world where everyone's feeling more disconnected and more isolated and more lonely than we've ever felt before. And I'm going to put 2 things down for that. Number 1, the smartphone, and number 2, COVID. And I think the knock-on effect of that is left people feel more disconnected and isolated. And right now, the government and other people are saying that we are in the middle of a loneliness and social isolation epidemic. 26% of households all across Australia are single or lone person households. That means one person living in them. There's 26 million people live in this country right now. Something like 11 million dwellings, 26% of them, so that's 2.5 million houses, have only got one person living in them. And this is why people are feeling lonely and afraid and scared and disconnected, because they're living on their own and they've got no connection. As human beings, we love to be around people. We love connection. Don't get me wrong, sometimes connection can be too much and you need your own space, but it's nice to have that option, right? Really nice to have that option. And that's why the HMO works so well. Affordability, convenience, and community are the 3 reasons. So what we've got coming to us now is we've got SIL providers, which are supported independent living, and these people funded through the NDIS, but it's not the same as SDA, which is special disability accommodation. So these are the 2-bedroom houses that we've been building for the improved livability, fully accessible or high physical support categories under the NDIS. For the people that do not have access to special disability accommodation through their NDIS plan, they have what's called disability support pension. And that disability support pension can be used for them to rent somewhere to live and to buy food and stuff like that. Now, their disability support pension, unfortunately, is incredibly low that even at the HMO Property Co, we cannot find or we cannot provide rooms to them under what is termed as affordable. And affordable is using no more than 30% of your gross income on accommodation. However, these people need somewhere to live. And then we've got the SIL providers that get paid through the NDIS for providing supported independent living care to these people. The problem is they cannot get paid from the NDIS unless they have somewhere for their SIL participants to live. So what the SIL companies are doing is they're approaching us now and they're saying, Neil, if you build us a 6-bedroom, 6-bathroom property in this area, I will give you a letter of intent to say that once you build this property, I will lease this property from you for 5, 10 or 15 years, whatever your investor wants, and we will guarantee their income for them. Now, what these rooms numbers look like, I'm just going to quickly pull my calculator out. So they're saying the maximum that they can pay on a room is $325 per week, which when you consider we're getting $350, $375, in some locations $450 a week for a room, doesn't sound that attractive. However, what these guys are saying is we'll pay $325 a room times 6, so that's $1,950 a week, and we will guarantee this rental income for the term of the loan, so that can be 5 years or 10 years or 15 years, we will increase our rent in line with CPI every year. So if it's 325 and then we see 3% inflation, your rent will go from 325 to 334. Again, not life-changing in the terms of when we do 52 times 6. Yeah, so still not too bad, 104 grand a year after you get your 3% increase. But the benefit for some investors is the SIL provider will also pay the electric, they'll pay the internet, they'll pay the cleaners, they'll pay the gas, and they'll pay the water usage. So all of a sudden, the HMO that you as the client invest in all of a sudden becomes like a standard investment property where you've got one tenant and where you've got one rental income. That rental income will be 325 times 6, so 1,925, I think I said it was. They will rent the house off you for $1,925 a week, times 52, and at the end of that 12-month period, the rent increases in line with CPI, and it continues and continues. The benefit for you as the investor is one tenant, no vacancies, no power bills to pay. You've still got to pay council rates. You've still got to pay some of your insurance. They will have insurance themselves, but your insurance premium will be less than a HMO. And then you've still got to pay your council rates and your water rates. Exactly the same as a standard investment property. And you got one tenant in there, but you've built a 6-bedroom house. Now, I've been saying, well, what if these people don't go ahead and don't lease these properties for us? Or what if we have problems with them and they don't, and they can't take that lease for 5 years? Let's say, for instance, because they get paid for providing care for the people in the houses, but they also take some of the DSP, the disability support pension, from the participant to help fund them in that house. So let's say, I'm going to throw a number out, I don't know the exact figure. Let's say they get $400 a week for their disability support pension. It's probably a lot less. Let's say $350. And let's say they take $250 off that participant and leave them with $100. But they provide their accommodation, they provide their food, and they provide their care as well. So they're left with $100 a week for like confectionery, for traveling, for drink and cigarettes and stuff like that. Whatever they do with that $100 is up to them. But the SIL provider will provide the accommodation, they provide the food, so it's nice and easy for them people there as well. Also, it provides connection and community for the people that live there, like we've said, one of the biggest things that people are missing right now, and helps you as the investor get a fixed long-term lease on your property. So these work on all types of HMOs, and if you've been following us for a while, you know that we do the one-part contract process inside the self-managed super fund. So you could do one of these 6x6 properties inside of your self-managed super fund, and the SIL provider will take the head lease on it. And then you'll have a guaranteed lease inside your self-managed super fund. You leave the property at principal and interest, and you just leave it, pay down the debt, and then you retire with a debt-free asset. That's cash flow and big money. You could take this back in 10 years' time. You can convert it back to a HMO. You can rent it out for more, depending on what the room rates are doing in the area. So, like, if it comes to the end of the 5-year lease term and you come to us and say, right, O'Neill, I've been leasing it to this SIL for the last 5 years. It's been fantastic. Room rates have gone from 325 to 375 with a 3% increase every year. But we believe the room rates in that area are now 450. Then we'd be able to do a calculation to see if we get you 450 a room, but we have vacancies every year. Let's say we factor in 3 weeks per room per annum into our cash flow forecast when we're showing people the forecast on these things. So you're losing 2 weeks vacancy there. We also charge a leasing fee every time we lease a room out, and then you're going to have to pay the gas, water, the electric, the internet, and the cleaners as well. So you've got to work out if that additional cash flow or that additional weekly room rate is high enough and beneficial for you to take that over the SIL head lease at $325 a week with no outgoings. Packages on these, if you're interested, look, land right now, I can't believe I'm saying this, but land, 375 square meters, we're seeing the kind of get-in price at the minute in a suburb that these guys want to be in is around $400,000. Now, let's go back 2-3 years ago. That same block of land would have been 250 grand, 275 maybe. And if we go back to the vacancy rate that we've been talking about and go back and talk about the people moving to the state, I think these $400,000 blocks will soon be 450 and they'll soon be 500 grand before we know it, in the blink of an eye. Construction's around $700,000, so you're all in for 950. So let's just do a quick calculation on this. I'm going to go 325 times 6 times 52 divided by 950 times by 100. So you got a 10.6% gross yield by going down the sill head lease option, and it's guaranteed rent for the duration of that lease. So what else have I got for you? It's pretty good. So yeah, it's funded by the NDIS. I've just got some notes here just to skim through, guys. It's supported by the NDIS, but it's not under the special disability accommodation funding. Now, if you go back to the podcast that I did with Brent Compton not too long ago, we spoke about the difference between SDA, special disability accommodation, and STA, short-term accommodation, and SIL, SIL, supported independent living. 3 totally different things. Only the SDA is funding under the NDIS, and this is when the participants need the funding in their plan to get access to their $85,000 to $95,000 a year rent that the NDIS will pay you if you build an NDIS property. This is different. As I said, this is more of a company that gets paid for providing care. So they'll just invoice, once they've got 6 people and they say, right, I've got 6 people here, I'm providing care. These people, they invoice the NDIS and the NDIS will pay them as a business. And then they will pay you as the owner of the property. Now, we've obviously done some checks on all of these people. We make sure they've got strongish balance sheets. Don't forget, these guys aren't the big boys. These aren't the Blue Rocks, the Rocky Bays. They're not the St. Judes and stuff like that. These are small entrepreneurial type businesses that are out there trying to make ends meet and trying to make things work. But we are checking to make sure they've got A, cash available, B, healthy balance sheet, like no debts on them. And because, again, our reputation hinges on us making these relationships the best ones possible so that you, as our investor, gets the outcome that you want. And before, I'll probably finish on this because that's all I've got to say. But before, if you are interested in this type of model that we've got, then we're obviously not going to jump on a call and go, oh, by the way, the company's this and you can do this and you do X, Y, and Z. We're not going to give that sort of information away because it took us a long time to get to this point. We've been having these conversations for like 7-8 months and it's only just starting to come to fruition now. So if you are interested, please respect the fact that we've got a bit of IP around this. We will share it with you, obviously, but we want to make sure that A, you're the right fit for the business, you've got the capacity to do a deal. And once you do that and you sign up to work with us, then we'll pull back the curtain and we'll show you absolutely everything. But until that stage, unfortunately, guys, then we are going to have to be a little bit careful around the IP because we don't want everyone getting access to it. And then we don't want the people that we're working with, we don't want their phones ringing constantly from investors going, oh, I've got a 4x2 or I've got a 5-bedroom house here. Do you want to take a lease on this? So just please, if you are interested, just have a bit of respect for the IP that we created on this. So to finish on a bit of downer, guys, it's, hope that all made sense. IBA cash rate, come down, fear and greed. I think we're moving into the greed phase where people are going to start feeling more confident and they're going to start coming back and start the houses that they missed out on previously. They're probably going to go back and try and buy it again or the better one, which is going to push prices up. Vacancy rate at 2%. Take that with a pinch of salt. We've still only got 2,000 properties available for rent on the market. REWA, please don't spread these sort of false rumours again or these false headlines, kind of like a false positive. And then last but not least, we've got the SIL head lease for all of you people that love certainty and deserve certainty as well. You're investing your hard-earned money into these things and you've got to be comfortable with the investment asset, the asset choice that you are investing in. You've got to be confident in the investment asset choice you are investing in. Did it again. You got to be comfortable with the team that you're working with. You got to be comfortable with the outcome that you're going to get from them as well, because don't forget, real estate is just a vehicle to get you from where you are to where you need to be. In my eyes, it's all about the numbers, but the numbers are attached. They've got dollar signs on them because you've worked hard to get these dollar signs so that you can now invest into these things to then generate a life that's worth living on the back end of it as well. So hope that helps everybody and wish you all the best with your investing, guys. I haven't said this for a while because I don't think the guests that I've had on the podcast have been relevant for it, but every master was once a disaster. Every winner was once a beginner.
Thanks for watching. Make sure you tune in the same time next week so you can stay up to date with all cash flow positive property updates.